Sagafi, Liberty Home Mortgage. And our mortgage rates higher, they're soaring and they're all over the place. And is real estate in bad shape? That's what I'm going to be talking about today, okay? So let me blow all that up and get rid of all of that talk there. Let's start with here first of all, okay? So right now while I'm doing this video, this is the last quarter of 2022. This is November of 2022 to be exact. Mortgage rates are easily in the sevens, possibly going up as high into the eights. You never know. I've seen some articles saying they're going to 10, but the gloom and doomers never stop coming out, okay? So make sure you're commenting all of your gloom and doom stuff in my comment section too, and I'll smash it to death on that one too. But remember this one here. If you buy a house today, let me give you three scenarios. I have a lot of data, a lot of tables just to debunk a lot of the myths out there for this, okay? First of all, if you buy today and you get a mortgage rate of 7.5, let's just pretend, okay? And rates go higher. You wanna know something? You're gonna be happy you got in today because you got a lower rate than you would have gotten 2 months from now. If you buy right now, rates go higher, guess what? You got in on a great rate. Scenario number two, you get in right now and in a year or 2 or 10, mortgage rates go lower. You wanna know something? Refinance, get a lower rate. That's the second option. Number three, don't do anything, just keep renting and sit on the sidelines and watch as the parade just walks right by your face. And in 10 or 20 years, you'll be looking back saying, at the end of the day, you know what? I should have gotten into the market. So at the end of the day, those are your three scenarios that I always tell people. Get in now, you'll be happy you did if rates go up because you got in at a lower rate. Get in right now, and if rates go down, refinance. Or just don't do anything, keep renting. In 20 years, you still own nothing, okay? That begins. Let's go in regards to interest rates. I have a lot of tables and stuff I want to show today. Let's go in regards to interest rates. I'm using $250,000 as a benchmark. On a loan amount of $250,000, the principal and interest payments, so I list out these principal and interest payments. At a 6% rate, principal and interest is about $1,500, $1,499 to be exact, okay? At 7% interest, it's $1,663. So it's about $160 more for 1 percentage point of interest. Let's go to 2 percentage points of interest at an 8% interest rate. On $250,000, principal and interest is $1,834. So you're basically paying about just over $300 more a month for a 2 percentage point swing in interest. Now here's the thing to keep in mind, is that in today's market, you're not buying for just the list price of the home at $250,000. A lot of people who are buying today don't realize that only 4, 5, 6 months ago, to get into the housing market, you had to go $50,000 over the list price of the house to get the house. And I have another table I'm gonna show you here, okay? On a $300,000 mortgage at 6% interest, principal and interest is $1,800 a month, okay? On a loan of $275 at 7% interest, principal and interest is $1,830. So watch this one. 4 months ago, if you looked at a house for $250, quite honestly, you probably had to give $275 to $300,000 to get the house. If you looked at a house for $275, you probably got to give $300 pretty easily, if not even more than that in a lot of markets, okay? The whole point of this table is, what I show you is I would rather buy at a lower price at a higher interest rate than buy at a higher price at a lower interest rate. Now watch this one. On $250,000 at a 9% mortgage rate, on $250,000 at a 9% mortgage rate, between a $250,000 loan at 9 and a $300,000 loan at 6, it's a $200 swing per month, $200 per month. 3 percentage points of interest shifting the price down because today you're not having to go $50,000 higher. Here's a fact. When mortgage rates go down, and at some point in the future they're going to, they go up and down, okay? When they do, refinance into the lower interest rate. Now, there's a lot of factors that go into that. I would never buy a house today gambling that I'm gonna refinance at a later time. But I will tell you, pay attention to your financials and set yourself and position yourself for it. Because here's the other thing too. Nobody keeps their house for 30 straight years in the same mortgage loan for 30 straight years anyways. In 4 to 7 years, I've got news for you. You're gonna be sitting here saying, if you're staying in the house, I don't wanna have this mortgage for 23 more years. We wanna go to a 15-year loan. You're gonna shorten that term down. You need to put some equity in the house. You need to make sure your credit's in line, your income, your debt ratio, your job, and a lot of other factors, okay? The fact of the matter is, I'd rather owe less money at a higher rate than more money at a lower rate. these tables give you examples as they lay that down. Here's a quick recent CNBC article which talked about rent in America, okay? Let's look at this. Rent prices are soaring. This article was from August of 2022. Rent prices are soaring in these 5 U.S. metros. Here's what to know to move to a cheaper area. So rent prices swelled during the first half of 2022, hitting a national average of $2,495 per month. The national average for rent in the United States earlier this year in 2022 was $2,500 per month. I've got somebody right now that's getting a mortgage rate in the 7s, almost in the 8s, and their new mortgage payment, almost at an 8% mortgage rate, is lower than they're paying for rent right now. Chew on that one. Tell me how bad it is to buy a house at an 8% mortgage rate when their mortgage payment is going to be lower than they're currently paying for rent. That's from this article from CNBC. There's another part to this article that I want to go into, actually. It's a few pages into it. It talks about the average rent in smaller markets, okay? 5 U.S. markets with the most expensive rents. It also gives the markets with the cheapest rents. Not the cheapest, but here's one for you. Flint, Michigan, $1,200 a month. Davenport, Iowa, $1,300 a month. I pulled up some homes for sale in Flint, Michigan this morning when I was getting ready for this video. I pulled up beautiful homes for $120,000, $130,000 that even if you put a 9% mortgage rate in there with taxes and insurance, the total house payment would have been like $1,100 per month. The average rent in Flint, Michigan is $1,243 per month per this article. You could buy a beautiful home in Flint, Michigan and have a lower payment on your mortgage than you have on renting in Flint, Michigan. People in Flint, Michigan right now are saying, Hesh, but you know, $4,500 is Los Angeles, because by the way, according to this table here, I will tell you, yeah, the average rent in Los Angeles, $4,664. San Diego, $4,600. Bridgeport, Connecticut, $4,300. San Jose, California, $4,200. So if you're in, you know, Flint, Michigan saying, Hesh, but that's Los Angeles, California, that's fine. In Flint, Michigan, I got news for you. It's $1,200. There's beautiful homes for sale in Flint where you can buy that home and have a lower payment than you're paying for rent, just like you can in Los Angeles. This data is just all over the place. There's a chart that I have also from the St. Louis Federal Reserve. It shows the median sales price of houses in the United States. Actually, if you look at this, I have the data here. If you bought a home at the peak of prices just before the last crash, because we all know, or people should know, the last housing crash was back in 2007, okay? There was a bubble, prices came way down. Dramatically different time. I have a lot of videos on that, and you'll want to watch those too. You know, how does this compare to 2008? It's not even close, by the way. But if you'd have bought a house in the first quarter of 2007 in the United States, the median price of a home was $257,000. Now listen to this one. By the first quarter of 2009, the median home price was $208,000. You would have dropped 20% on the value of your home. Let's pretend you went VA and you went no money down. You'd be sitting here saying, I owe $257,000 and this house is only worth $208,000. I'm underwater by over $40,000, actually almost $50,000 underwater. Oh my God, what did I do? Watch this one, okay? By the first quarter of 2013, from when you were at the bottom in 2009, only 4 years later, you'd been back to $258,400. By the first quarter of 2013, you'd been back up to $258,000. That means from start to finish, when you bought in early 07 to early 2013, a 6-year period, your value would have been the same. That's the same start to finish with the biggest crash in housing history since the Great Depression. In between those two, the peak to peak basically, or at that time was, okay? Now watch this one. By the fourth quarter of 2014, only a year and a half later, the median sales price was almost $300,000. You'd have been 15% up on the investment you bought in 2007. Now watch this one. By today, if you owned the same home today that you bought in 2007, it would be up to $454,000 based on median home prices. You're up 70, that's a 70%, that's almost a doubling of the value, okay, of what you're looking at here. Don't buy into all of this doom and gloom. Housing is not bad. If you'd have bought in 2007 during the crash, you'd have been literally more than double your value. If you'd have bought at the peak before the crash, just surviving that crash, you wouldn't have lost $1. And then waiting just a year and a half beyond that, your home value is up 15, 16% like I already gave you. Let's talk about tax benefits really quick. So I've given you the data. Let's go over some tax benefits. This is other stuff that people don't talk about. You've got to remember this one. I have a chart here that if you're paying on an interest rate of 9%, okay, a mortgage with a 9% interest rate, assuming the average family household income is like $50,000 to $100,000, you're in the middle tax brackets over there, okay? So a lot of this is some accounting and making some estimates here, okay? But if you're at a 9% mortgage rate, after you get to deduct the mortgage interest from your taxes, it gives you an effective rate. You effectively would have paid an interest rate in the 6s. So people hear 9s, but don't forget, during tax time next year, you're getting a much bigger income tax refund. You're being taxed on less income, thereby you're getting more money back or paying less money in. That counts, and that counts big. And do you want to know something? When you're paying $2,600 a month for rent, or you're in Flint, Michigan, and you're paying $1,200 a month for rent, in 1 year from now, you don't get $1 of that back. In 5 to 10 years, you don't get $1 back. In 20 years, not only haven't you gotten $1 back, but you built zero equity. Renting builds no equity in anything. I don't care if the interest rate is 11%. Do you want to know something? Even at an 11% interest rate, number one, you get a tax benefit from it. Number two, as you make your payments, you are building equity. You're taking ownership of something and gaining a bigger portion of control every single month that goes by that you make a payment on it. So when it comes to home ownership, again, when you factor in the tax savings, even an interest rate of 9 is not necessarily an interest rate of 9. And that's a lot, there's a lot deeper discussions on all of that. But the whole point is understand that mortgage rates are higher than they were, but they're coming into line with where they've been historically. They might even go a little bit higher, but there's great news coming up on the front. You want to follow my other videos where I talk about the Federal Reserve's next move and other things of that nature. But on that note, make sure you subscribe to my page so you watch more videos like this. Make sure you share this on your page, put your comments below, and definitely like this video so others can see that and keep moving forward. And pay attention to my upcoming videos, and I hope to be seeing you on the next one.